G'day folks, Jim here from Altered Forex. It is Sunday the 31st of January. Well, last week was fairly volatile and choppy for the currency markets, but the US dollar is actually a little changed at the end of it. Although from a technical perspective, there are hints that we could be in for a decent move in the next few days, and we'll go and have a look at that in a second. Sterling finished on a relatively strong note, while the Aussie and the Kiwi both finished lower as negative risk sentiment setting as seen through the stock markets. And US stocks did have a tough day on Friday, despite some upbeat corporate earnings reports, and not helped by some negative headlines with regards to the availability of vaccines and the possibility of them not being successful against future mutations of the COVID virus. So that put a bit of a dampener on markets. And the S&P in particular looks heavy after having made a new all-time high on Tuesday. It's closed Friday by carving out a bearish outside week reversal, and the Dow is also back below important support below 30,000, and it does appear from the charts as though we could have more downside ahead of us. Looking ahead to the calendar, the week begins on Monday with the global manufacturing PMIs, and ends with the US unemployment and non-farm payroll figures for January. So, and in between those, we've got central bank decisions to come from both the Reserve Bank of Australia and the Bank of England, and there's going to be plenty of else besides, including the EU Q4 GDP, and there's the January CPI numbers, as well as the global services PMIs, and plenty of secondary data as well. So in the meantime, before we go and look at any of the charts, we'll just have a quick view of the trend table, and then I'll go into the dollar index. So starting with the trend table, as with last week, the majority of the currencies still look pretty neutral, and so do the crosses. The real interest has been in the stock markets, whereas I said just now the S&P appears to have more downside ahead of it. The Aussie market, which I follow as well, that looks increasingly heavy. Despite the currencies looking fairly neutral, the dollar index does seem to be turning a little bit higher, and there's an interesting chart formation there. We'll go and have a look at that in a second. Elsewhere, gold didn't do a lot on Friday, although silver had a strong up session. I think I finished up about just under 2%, I think. Gold didn't do an awful lot, and that's holding on above important support. Oil's going nowhere fast, really. As far as the crosses go, bit difficult to see. I think the EurUsd looks as though it might have some near-term upside. On the other hand, Aussie Kiwi does look as though it's going to head back to the downside. So we'll go straight into the dollar index. Okay, so here we have a daily chart of the dollar index, and as you can see, the dollar index, the top product here, that finished at 90.58 on Friday, up 0.15% on the day. And really the whole week was pretty quiet, really trading between 90 and 91. But interestingly, we do have this inverse head and shoulders, which seems to be reaching maturity here. The neckline, we really need to see a break above, well, 90.85 is the level, but if a daily close above here, but really above 91, I think, could take us quite swiftly onto the projected target from the base here, 89.20 up to 91, that's 180 points. From say 90, from the neckline 90.80, that would take us up towards 92, which kind of comes in with the 100-day moving average, and beyond there at 92.5 we've got 38.2% FIBO objective. The daily indicators do appear to be pointing a little bit higher. If we move further out to the weeklies, you can see on this weekly chart the reverse head and shoulders there, the downtrend line going back to when March this time last year, really. So a break of this is going to be quite important, and I think we could quite quickly move up towards this sort of 92.5 level. The thing that makes me fairly confident that we are going higher rather than lower is that the weekly indicators, having got themselves relatively oversold, are now crossing higher, and the momentum does seem to be to the upside. So if anything, I'm looking to play the US dollar from the long side, particularly against well, dollar Swiss is we'll have a look at dollar Swiss in a second, but dollar Swiss or the euro, I think, is the way to go. So starting the currencies with the euro, and as you can see, it has been fairly choppy. This is a 4-hour chart, but we've got the neckline of that head and shoulders just here, and that's just around this 120.5 level, and from the peak here at around 123.5 down to the neckline at 120.5, that's approximately 3 big figures, which from the neckline would take us down approximately to 117.5. That's a long way off at this stage. There's good support here. We'll have a look at the dailies in a second. So we until we really break down through this, really down through the 50% Fibo pivot, I wouldn't get too excited, but that does seem to me that that's going to be the way of it. The 4-hour charts are really not telling us anything at the moment, though, and really neither the dailies. So it may be that we muck about around here for the next few days, but eventually I do think we see this drop. When we get to this level down here, we've got the 119.40. We've got the 100-day moving average coming in, but as once again the indicators look fairly flat. The weeklies, let me blow that up a little bit. The weeklies may be turning a little bit lower, but once again, there's not an awful lot of momentum. But I do think we've probably made a medium-term high here, and I'd rather be trading from the short side. Now we can actually see this better in dollar Swiss. So the reverse head and shoulders dollar Swiss, the neckline is here at 89.30 and 87.5, was that 89.20? So it's about 160 points to the top side, which would take us from here back to around just probably about in line with this high here, just shy of 91 the figure. That's if I'm right on this, but it's going to need to break this 89.30 level first. Once again, this is a 4-hour chart, not showing us an awful lot, so maybe we do just muck about here. And it could be that we do that until Friday when the non-farm payrolls come out. But if we go forward to the dailies, you can see it looks a pretty nice formation. The 100-day moving average is in here at 90.25, so that would be some resistance to work through, as would these previous lows here down around here, sort of 89.80 or so. So just keep an eye on it. The dailies are not showing us an awful lot yet, but I would certainly be preferring to buy dips, probably with a stop loss under this sort of shoulder here, so 88.25 or so, 88.20. I'd leave a stop loss underneath there in case we're wrong on this and the dollar does resume its downtrend. Moving forward to dollar yen. Now dollar yen did pretty much exactly as we described last week. It did break out of this wedge to the top side. It's taken out the 100-day moving average, and it's reached a high just shy of 105 on Friday before finishing at 104.70 right on the Fibo level. Now I do think that dollar yen may move a little bit higher yet in line with the view of the stronger dollar, in which case the next level of resistance would be around here, 105.60. That's the 200-day moving average, and then at call it 106. On the downside, this 104 level, 103.80, 104 should now act as support. I would leave a stop loss back below there though, or ideally back below this low here. That's 103.30, maybe a bit too far off. So, but definitely below this wedge here, 103.80. I'd leave a stop. The dailies do appear to be picking up some momentum, but dollar yen's been in this choppy descending formation for some while now, so it may be that we need to unwind some of those shorts and head to higher ground. The one thing to watch out here for on dollar yen, I have to say, is if we do see a major turn into negative risk sentiment, it could see the yen move back into favour as a safe haven. So while I do think the dollar goes higher, you do need to keep an eye out for lower stock markets, which might see demand come back into the yen again, which we haven't really seen for the last few weeks. Sterling. Sterling might be the currency that goes against the general trend here. It looks as though that's got a reverse head and shoulders of its own against the US dollar. This is a weekly chart, so it's long term. It's not going to happen in a hurry. but we are trying to break above this neckline here. This 137.40, 50 area is decent resistance. If we do, it's well, this is a 20 big figure move from the neckline down to the base. So that takes us way higher, so 155, 157 or so. But the weekly charts do look fairly positive. So coming back to nearer home, the dailies, as you can see, are in a fairly steady uptrend. They're not overbought at all. The indicators not showing us a great deal. They're pretty much middle of the road. Maybe the stochastics are pointing a little bit lower. But if we then come back even closer to home to the 4-hour charts, we can see that the price action has remained pretty choppy over the last, well, since the turn of the year really. And it may well continue that way for the coming week. I'd be looking to buy dips sort of down around this level. So what is it, was 136.20, and for the time being, I think you've probably got to sell them out at 137.60 in the absence of anything else. Don't forget we've got the Bank of England on Thursday, which will be the first major test. Although the PMI, the manufacturing PMIs today might see a bit of volatility, but the Bank of England on Thursday will be the and what the future outlook for policy is from the bank. That's really what's going to decide direction, I think. And then of course we've got non-farm payrolls on Friday. So until then I'd be playing the range, as I say. So 136, 136.20 on the base, 137 sort of 60, 70 on the top. Aussie, the dailies on the Aussie are looking pretty heavy, and although we are sitting above support here at this sort of 75, 80 level. If we do break through that, then I think we're possibly, we've got a fair bit of downsides ahead of us. This low here, coming in with this high here, it's sort of 74, 10, 15 area. We've got the 100-day moving average at 73.65, and further away we've got 72.70 is the first FIBO target. But the indicators do point a bit lower. The 4-hourly charts, not telling us a great deal at the start of trade on Monday, but with the Aussie being here at 76.40, I think I'll be looking to sell. I don't think we're going to get there, but I'll be looking to certainly sell into any rally towards 76.80, 77 cents, because I think with the way the dailies are pointing, we've probably got more downside ahead of us. The weekly charts further out, they do seem to suggest that the indicators are topping out. And so I suspect we can head lower, with direction really probably going to be dictated by the moves in the stock market. And if the S&P does as I think it's going to in heading lower, then the Aussies are more or less bound to come down with it, I think. The same really applies to the Kiwi. I won't spend too much time there. Once again, the indicators might be pointing slightly lower. The Kiwi's chopping around though. Aussie Kiwis, because of the Aussie weakness, that's dragging the cross down, and the Kiwis not really doing quite so much. But if we break down below this sort of 70, 71 figure area, there's trend line support at sort of 70.20, and then the FIBO, we're some way off now, just down around 69, just below 69 cents. I think that's possibly the direction we're heading in. I would, if I was selling it, I would probably be buying it back above 72.5, and certainly I wouldn't be short if we saw another move back above 73.15 or so, this top up here. But in the meantime, I actually think we are going to see further downside momentum. Just moving forward onto the crosses, and Aussie weakness seems to be the general theme here. So here we have a 4-hour chart of Euro Aussie, which seems to be pushing on a little bit higher. It's pretty volatile. But the 4-hour chart's not telling us a great deal, maybe trying to point higher. The dailies, equally, they seem to have some mild upside momentum. This high here, 159.40 or so, is going to be the immediate resistance. But if we can get above there, maybe we can extend even as far as this back to 162, which we haven't really been since this is early December. So I'd rather be long the cross, this cross short the Aussie, and looking for that. Stop loss I would probably have, where are you now, 158.70. I'd probably have a stop loss 100 to 150 points away, or looking to buy dips perhaps, but I'm not sure we're going to see too much of a dip early in the week. The manufacturing PMIs out of Europe could see some volatility in the euro today, so that's just something to be aware of. Moving along to sterling Aussie, Now sterling Aussie, this is a daily chart, so we're up against the 100-day moving average. And given that I like sterling better than I like the euro, I think the euro can come under pressure from a stronger dollar. I think sterling is going to withstand that better. So I'd rather be long sterling Aussie than euro Aussie, but I think they're both going higher. Sterling Aussie will face resistance at 180 again, but if it can get above there, the 200-day moving average is at 180, 130 by the looks of it. So I'd be looking to buy it maybe down around 179, 178 and a half, 179, something like that, and looking with a 100-point stop loss and looking for a move to the top side. The other cross, Aussie Kiwi, having closed below the 100-day moving average, Aussie Kiwi has dropped quite sharply back to 106 and a half. And the indicators suggest there's more weakness ahead. I don't really trade Aussie Kiwi myself. As you can see, it is very choppy within this sort of parity to 110, which seems to be where. Let's have a look at the weekly chart. And as you can see, really going back here to 2013, we've been stuck in this very choppy sideways range. I think there are easier currencies to trade. The weeklies are not really showing us anything. But if you wanted a short-term punt, maybe go short across. The weekly moving average, the 100-week moving average at 105.80, which isn't so far away. Certainly, if we saw a close below that at the end of this week, then I would consider shorting it, looking for a move back down here and possibly even lower. Now, moving forward to the stock markets and starting with the Standard & Poor's 500. As you can see, this is a weekly chart we've got here. And if I blow this up, although it's a bit difficult to see it, but this was a new all-time high on Tuesday. Friday's close, so higher high, lower low than the previous candle, and closing near the low suggests to me that's a bearish outside week, and we could see further downside ahead of us. The weekly indicators are looking heavy. The monthlies are very overbought as well. Coming back to nearer home, the dailies not telling us an awful lot, but I do think we've got a bit of downside ahead of us. We've got going to have support here, 36.50, 60, something like that. Again at 35.70, and then the first Fibo's down here at 34.60. I'm not sure we're going to go that far. A lot's going to depend on how the new Biden regime copes with the COVID issue in the States, which seems to be completely out of control. But if things start to improve there, this may be a good dip to buy into for the next move higher. But right now, I'm looking for a break of this line, 36.60, and I think we're probably destined to head towards 3600 and possibly 3500. The 4-hour charts, as far as Monday's concerned, very choppy. 4 hourlies are somewhat oversold, so we might see a bit of a rally. If we saw a move up to sort of 37. 37 and a half or so, I think I'd be looking to sell into that with a stop loss, I guess above 37.70 or hopefully above 38.20, but that might be too steep for some traders. Looking towards the ASX, this is a chart of the SPY, and that closed. It took out this rising trend support, closing near its lows and looking really to me as though it wants to test this sort of 63.5 level, which is 150 points away. And maybe we don't get there. The dailies are not showing us an awful lot. They are a little bit heavy perhaps. The weeklies do look somewhat toppish, but we've got this sort of consolidation area and we're still in that. So it may be that we just chop around here, but I would be looking to sell rallies because I do think we're probably going to head lower. And as I say, I'm looking for an initial target now around 63.5, 64, somewhere around there. And if we do get back down there, I'd be tempted to start looking to buy dips again, because I think we've probably got another leg ahead of us on the top side, although that looks to be somewhat delayed for the time being. A quick look at the commodities. This is a daily chart of West Texas Intermediate, and really this is a daily chart. As I say, yeah, it's just trading sideways, doing very little, and the 4-hour charts are not showing us anything. In the bigger picture, we've got this channel right near the top of it. If anything, I'd probably be looking to sell it here at sort of 54.5 with a tight stop, as with last week, really probably about 56. but looking for a bit of a move back towards the downside, towards the middle of the range. But really, I think right now, as I think we said last week, 50 to 55, more or less, where's 50? That more or less covers it, and I doubt we're going to get very much movement this week unless the non-farm payrolls comes in hugely away from general expectations. As far as the metals are concerned, gold didn't do an awful lot on Friday. In fact, gold spent most of January chopping around in a sort of $50 range between sort of 1820 and 1870, and that may well continue to be the case. If we go forward to the daily charts, we're currently sitting right on the 200-day moving average and above this important support here. It comes in around 1820. If we to break below that, then I do think we can probably come back down to this these previous lows here, this high and this low around 1760. I think that may be the direction of it. I'm not really got an opinion on gold at the moment though. Safe haven demand, if we see stocks lower, safe haven demand might drive gold up. But for the moment, look for 1815, 1820 as a pivot. A daily close below that, then I think 1760 is not so far away. But as long as 1820 holds, then we might go back to the top of this trend resistance here, back towards 1925, 1930. I don't think we're going there this week, but that would provide good resistance if we see it. Silver, on the other hand, had quite a good day on Friday. Silver had a sharp move higher and is sitting up here against trend resistance. The indicators are not telling us an awful lot. I don't think silver can go very much higher without a positive move in gold. So it might be worth a sell here with a tight stop loss. But if we look at the weekly charts, they've spent quite some time correcting their overbought nature, and they're turning neutral, possibly turning a little bit higher. So I'd probably be a buyer on a decent dip in silver, I think. But as I say, without gold moving up, I'm not sure silver's going to do it by itself. If we do see gold starting to move higher, then and we break this trend line that we saw on the dailies, then I'd probably start to go with it. But early in the week, while there's not too much out ahead of the non-farm payrolls, I think I'd probably be looking to sell it up here at 27. Probably a stop loss above this high here, it's above 28. So sell at 27, 27 and a half, something like that, with a stop loss above 28. Or alternatively, look to buy it down around sort of 26, 25 and a half, something like that. Looking for an eventual move to the top side. So that's about it as far as the markets are concerned. The calendar seems to me that there's a bit of domestic Australian data out Monday, German retail sales, but the main event will be the manufacturing PMIs, so the ISM on Monday. Tuesday is RBA day. They won't be doing anything, but they might look at prolonging the quantitative easing program. Later on, we've got the Q4 EU GDP, the preliminary figures for that. Not an awful lot out of the States once again. Wednesday, we've got some early New Zealand data, and the services and composite PMIs. They'll be the main focus of the day, along with the EU CPI and, of course, the ADP. ADP looks like it's supposed to gain 40,000 jobs this month. Then on Thursday, really, Bank of England will be the main event. Not an awful lot out. Some secondary data out of the States. But the main event will be on Friday when we've got the non-farm payroll. The early Friday we see the Australian retail sales for December and the monetary policy statement. The main event of the day, though, will be the non-farm payrolls, looking to put on 85,000 jobs. So that will be about it, and it's a little bit of a thin week for data perhaps, but there could be a fair bit of action if the Bank of England or the RBA spring a surprise, or if the non-farms comes a long way from expectations. So that's about it for this week. Thanks for watching, folks, and we'll be back next week with another outlook. Cheers.